Hey everybody, welcome back to Whiteboard Finance. In today's video, I'll be revealing my portfolio of stocks, 36 of which pay a dividend totaling a truly passive income stream of $760 per month. I'll show you my income calendar of when those dividends get paid out, future income projections, pros and cons of individual dividend stocks, and some reasons why people are against dividend investing in the first place. So just a quick definition of what dividends are. Dividends are a distribution of profits paid out to investors. So if companies aren't using this excess money, this excess profit, this excess gross revenue to either invest in the company via research and development, acquire other companies in their field to consolidate and become bigger, or just whatever reasons companies use money for, they can actually pay these out in the form of a dividend to their shareholders. So it's kind of like a little, hey, thank you for investing with us. So let's get into the portfolio. I'm going to show you that right now. I haven't done one of these in about a year and a half. And actually, I'm recording this on one of the worst or reddest days in history in the last 4 years, basically since the COVID crash. So this is being recorded on Friday, August 2nd, and you can actually see the balance is down 2.4% overall today, but it is sitting at $446,000 with annual income of $9,124. If you divide this by 12, you get just over $760 per month with a dividend yield of 2.04%, yield on cost of 2.37%, and a beta just under 1, which is basically correlated to the stock market. 1 to 1 would be exactly correlated. Anything under that is a little bit less correlated. So let's get into what the actual income calendar is so you can actually see when I'm getting paid out. This service is called Simply Safe Dividend. I wish I was an affiliate for it because I've been using it for years, but they don't have an affiliate program, so just go ahead and check it out. Tell them I sent you. And basically, you can see here how I'm getting paid out. So some people, they like to buy monthly dividend stocks. Most dividend stocks pay quarterly. And then I do have one target date fund from my Roth IRA that pays out annually, which is in December, which is why this bar is so much higher than the other ones. So if you see this, I'm getting $44 a month regardless. Some months 54, some months 48. And then every quarter, you can see here is roughly $1,700 per quarter, okay? So if I break those down, let me sort these by largest to smallest, and you can see them right here. So full disclosure, my biggest position is actually VTI, which is basically a, how do I say this? It's like a growth/value U.S. total stock market fund. So it's not necessarily a quote-unquote dividend stock or a dividend ETF, but I'm a big believer investing in U.S. domestic stocks with some international exposure, which you can see here as well. So basically, the second biggest dividend holding, or the second biggest, or the first biggest dividend focused ETF is actually SCHD, which is bringing in $2,100 a year. The next one is my target date fund. This is just something I set up years ago in my Roth IRA. Then we have International VXUS, and then small cap right here. The next biggest dividend ones are actually everything down below here, from $300 a year with VYM all the way down to $8 a year with Leggett and Platt, totaling $9,100 per year. So the reason for that is just because this is just a combination of all my portfolios. It's a dividend portfolio, my taxable portfolio, which is mostly VTI, and then you have my Roth IRA, which is a target date fund. So what I want to show you next is the income forecast. This is pretty powerful. So based on that, the dividend growth per year is 6.6%, which is pretty good. If I reinvest the dividends via DRIP, dividend reinvestment plan, if you don't know what that is, it's basically when you opt to not see the income or earn the income or realize the income that your dividend yield is throwing off, okay? So say, for example, you have $9,000 a year in dividends. I have every single one of these accounts set on DRIP, meaning that $9,100 is being reinvested every year, okay? So no matter what I do, I have $760 a month going back into the market, buying me more shares of each holding, okay? So that's when you start to really see the dividend snowball start to compound. And in this assumption, I have $1,000 per month contributing new money to this portfolio. So between the dividend growth, the dividend reinvestment, and then also the annual contribution of $12,000 per year, these are the projections based on my current portfolio, which I think is pretty interesting and powerful. So let's say, for example, it's the year 2024. You can see here that just 10 years from now, if I were to keep this up, and the portfolio grew at, let's say, 7% per year, this is going to be throwing off $21,400 per year. If you go forward 20 years into the future, this same portfolio, based on these numbers, would be throwing off $45,500 per year. If you look at assumptions that are a little bit higher, let's say 8%, I mean, this portfolio can get to $53,900, and that's almost a livable income if it's adjusted for inflation and you maintain your purchasing power. Where I live, based on my monthly expenditures of having literally no debt, I could live off 55 grand a year, right? And I would never have to touch the principal. So that's kind of the power, or the psychological power, of dividend investing. And the reason I say psychological is because I'm actually going to give you a case that people make against dividend investing later in this video. Okay, so let's get into some of the pros and cons of investing in individual stocks. This could be any stock, doesn't necessarily have to be a dividend stock, but I think it's pretty important to see this. So you can see some of these holdings. If you see where my cursor is on the right-hand side of the screen, I'll actually zoom in so you can see these numbers a little bit bigger. Some of these positions are up 92%, 76%, 48%, 40%, so on and so forth. But if you actually go down to the opposite side of that spectrum, some of these positions are losers, right? You have negative 25%, 41%. 46% is actually GameStop. That was just bought as a joke. So don't disregard that one. But you can see the worst performer since I started investing in it was Leggett and Platt, right? It's not a big part of my portfolio, but you know, these things do happen. So the reason I say this is because with dividend stocks, the more your share price goes down, typically the higher the yield is going to be for that dividend stock, okay? So you don't want to be enticed by dividend yield. So a lot of people, they chase yield. So the dividend per share divided by the current share price is how you get dividend yield. So for example, if a company is trading at $10, okay, and they issue an annual dividend per share of $1, it's simple math. It's 1 divided by 10. The company's dividend yield is equal to 10%. Well, sometimes this isn't always the best example, and you shouldn't chase yield if the company you're investing in sucks to begin with, because you're going to experience capital destruction, okay? So that's like saying a house, I bought this house for, let's say, $200,000. It's making me $1,300 in rent. Now the house is worth $100,000, and it's making me $1,500 a month in rent. Well, the equity of your house just went down by $100,000. Same thing with these dividend stocks. You can't just look at the yield. And here's a perfect example. So a super popular dividend stock is Realty Income because they grow their dividends. They've been paying out dividends for years. And a lot of dividend investors love Realty Income, right? Right now it's yielding 5.37%, but look at what it's done over the past 5 years. You're down 12.78% overall. So if you had $1 million in this stock, you'd be down $127,800 at the time of 5 years, at the time of this recording. So if you had 100 grand, you're down 12,780, right? So it all just depends how much you have invested in here. People say, well, you know, Marko, I have drip turned on. I'm reinvesting. I'm buying shares cheaper just with my dividend purchases. Well, if you look at something that I'm heavily invested in, like VTI, look what this has done over the past 5 years. It's up 75.12%, and that still pays a dividend. So I can show you right now how much VTI pays. So if I go to percentage of portfolio, VTI is the highest. Right now it's yielding 1.39%, which is not good in a dividend terms. But if you look at the gain, I'm up 12.4% since I even started buying this, and that was only a couple years ago in this portfolio. If you look at 5 years, you'd be up 75%. Okay, so you need to take that into consideration. So make sure that you're maintaining your purchasing power. So between the dividend yield and the dividend growth and the share appreciation, like the house going up in value, those all need to beat inflation. So if inflation is 5%, let's just say, for example, between the dividend growth, the dividend yield, and all that stuff, those things need to be growing more than inflation. Otherwise, you're just breaking even or maintaining purchasing power, potentially even losing it if it's below the inflation rate, right? The whole reason we invest is to maintain and increase our purchasing power over time. You can't just look at it as a number, okay? Well, my wealth went up 5%. Well, congratulations. If inflation is up 10%, you just lost 5% of your purchasing power, right? You have to look at it in terms of how much can my dollar buy today? How much can my dollar buy 20 years from now, okay? Okay, so the next thing I wanted to touch on in this video, because I want to be as unbiased and realistic and as fair and objective as possible, is actually the case against dividend investing. And there's a couple of key points here that I'll described to you in a nutshell. But first, let's get into today's video sponsor, Policy Genius. Life insurance is my family's financial safety net. Did you know that 40% of people with life insurance wish they had purchased their policies at a younger age, or that nearly half of American adults, 46% in this case, expect that if they did die today, their loved ones would inherit their debt? This is why my family chose our life insurance plan using Policy Genius. Getting started with Policy Genius is simple. We filled out our information on the website, talked to one of their award-winning licensed agents. She walked us through the planning process step by step and got back to us with quotes that made a lot of sense financially and covered our needs. Policy Genius knows how valuable your time is. Their technology makes it easy to compare life insurance quotes from America's top insurers in just a few clicks to find your lowest price. 80% of Americans overestimate the cost of life insurance. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options are 100% online and let you avoid unnecessary medical exams. Their licensed, award-winning agents can help you find the best fit for your needs. They work for you, not the insurance companies. That means they are not incentivized to recommend one insurer over another, so you can trust their guidance. Policy Genius is for parents, caregivers, and anyone else who has people who depend on them. They simplify the process of getting life insurance so you can protect the people you love. Although some of you have life insurance through your employer, you may not be as well covered as you think. Your family deserves peace of mind. A life insurance policy through Policy Genius can give it to them. Head to policygenius.com/whiteboardfinance or click the link in the description to get your free life insurance quotes and see how much you could save. Okay, so let's talk about 2 reasons why people don't like investing in dividends, okay? And these are 2 fair arguments, and I completely understand where they're coming from. Remember, I mentioned earlier in the video that there's psychological factors as to why people invest in dividend stocks. There's also some other factors like, hey, they're typically recession resistant. They're typically mature companies that have the ability to pay out a dividend. It's more of like your defensive stocks, right? Like Procter & Gamble, things like that. But in a nutshell, the case that I see online all the time, and to their credit, I do agree with this, is that receiving a dividend is the same as selling a portion of the stock, okay? So if you had a growth portfolio that grows a ton over time, it just compounds. It's a compounding machine, like the S&P 500, for example. You can pick and choose when you want to sell the amount of stock that you want in order to receive the profit or the income by selling those stocks, right? Say you started with 100 grand in year 0, and then in year 25 you have 500 grand, right? Well, you can shave off a little bit in year 20. You can shave off a little bit, whatever you want in the way, during the way, along the way. Sorry, I can't English today. But basically, what dividend investors are doing is basically creating unwanted taxable events by receiving those dividends, and they're also limiting their growth. So say you have a stock that's $50 per share and it pays you out a $2 dividend. Well, that share price is going to go down to $48 roughly, okay? So what you're doing is you're destroying the growth by choosing involuntarily, because these dividends are paid out on a set schedule, to receive that dividend. So it's like you taking out your money, paying for it, the bank giving you back some money, but also lowering your account balance in a way, right? Or you can choose to drip it. I understand all that stuff. In that case, if you drip it, you're getting the money, and then you're buying it back at a lower price in that moment, okay? The second part, as I alluded to just now, is you're creating an unwanted taxable event depending on the type of account that these dividends are sitting in, okay? These could be sitting in a tax-advantaged account like a Roth IRA, which I'll get to later, but typically dividends are taxed 2 ways. You have qualified dividends that are taxed at either 0, 15, or 20%. Then you have non-qualified dividends that can be taxed at income rate levels, right? It can be up to 37% at the time of this recording, depending on the tax bracket that you're in. So to be a qualified dividend, there's a couple different criteria. I won't get into that just right now, but just know that when you do invest in in dividend stocks, make sure that they're qualified, because your taxable rate is going to be significantly lower, if not 0, depending on your income. So this is why a lot of people, it makes sense to build a dividend portfolio inside of something like a Roth IRA, right? Because if you're realizing those dividends, or you choose to convert a growth portfolio in your Roth, say, for example, you're investing in SPY for 20, 30, 40 years, and it grows by hundreds of percent, hopefully, by that time. You can then convert that into a dividend portfolio, and those dividends aren't going to be taxed because you're already investing with after-tax money in this tax-advantaged account, okay? So the philosophy in a nutshell is growth while young, dividends when older, okay? If you remember earlier in the video when I showed you that income chart, if I'm receiving that income in my dividend or my Roth IRA, I can choose to live off that 50, 60, 70 grand a year in dividends, right? And I'm never selling, creating taxable events or even selling the underlying that are sitting in the Roth, right? So it's like receiving the rental income from the house without having to sell the house, if that makes sense. So just to conclude, dividends, they can be a great way to earn passive income, but this all depends on your investment goals. Remember, this is just my personal experience and my objectives. I have a lot of growth stocks. I have a lot of meme stocks. I have a lot of dividend stocks, right? And I like to have a well-balanced portfolio in that regard. But my biggest holdings in my taxable account, the second biggest one is SCHD. So I'm kind of putting my money where my mouth is. And remember, the takeaway from this is you don't need, $500,000 in the bank account or anything like that, or your portfolio account to invest. However, these things do compound and they do grow over time, okay? My yield on cost is so low is because I've invested so much money in like VTI and things like that. But once you get the big wheel turning or the little snowball collecting more and more snow, becoming a, avalanche, if you will, then at that point, that's when your dividends, they can start really compounding. So I like dripping because now if I never invested another penny into my portfolio again, I know that I have at least $760 a month being invested on my behalf. You can argue that the dividend stocks are getting cut by the amount of dividend that they pay. I get all that. But for me, it's almost like psychological peace of mind knowing that I never have to invest another penny, and I know I have $760 a month going into the market for the rest of my life, knock on wood, barring, certain geopolitical events that are actually happening right now. So all joking aside, I still think that a well-balanced portfolio is good, but if you're young, focus on growth. When you're older, focus on dividends. Thank you so much and have a prosperous day. All right, if you went golfing with me right now and I showed up in this shirt, what am I shooting? What am I shooting? Tell me the score.